Happy New Year, everyone. I love doing these videos. They're my favorite type. We'll go through 6 or 7 charts around Australia. You know, this year house prices are going to fall. But, here's the but, there are numerous locations that are going to rise up to 10%, up to 20%, and beyond. We'll go through interest rate scenarios, inflation scenarios, population growth scenarios to go through what will happen in each city. We'll also touch on regional locations at the end. I've got 7 charts, going to be jam-packed, so much money to be made, even though headlines will say property prices going down. My name's BK and I help people build passive income through the Property Investment Accelerator using data without needing a $15,000 buyer's agent every single time. This channel will expose the reality on the real estate market, the economy, and financial happiness. I'm not going to ask you to hit subscribe. You do that if you thought you got value right till the end. Let's go. Now, SQM Research, every year they provide their boom and bust report, which is very thorough. Generally, they are directionally correct, although the quantum by which they predict cities to grow tends to be quite conservative. And on the flip side as well, they've created 4 scenarios. The base case is a 25 basis point to 50 basis point cut in interest rates, population growth at 500,000, and no new inflationary outbreak. Their second scenario is no rate cut. You know, for those of you who think no rate cuts are on the horizon, this will be an interesting scenario for you. Growth continues to happen, population 500,000, and no new inflationary outbreak. Now, scenario 3 is a rate cut in the March quarter, okay? Rate cut in the March quarter, so quite early. Population growth continues at 500,000, and the scenario 4 is population growth falls to 400,000, okay? So it's still massive, just not as much as 500,000. No rate cut, and commodity prices remain stable. So this is quite a pessimistic one. The most optimistic scenario is scenario 3. The most pessimistic is scenario 4, and the base case and scenario 2 are somewhere in the middle. Let's just start with the base case. They reckon Perth is going to rise in value by 14% to 19%. Now, I know I've done videos before saying don't buy in Perth, predominantly speaking, and we've stopped buying in Perth. So it's like, hey, PK, how can you agree that Perth is going to rise by up to 20%? In fact, I'm going to tell you right now, I think Perth might go up by 15 to 25%. So how can I still say that we're not buying there? And the reason is just because a place is growing in value, that doesn't mean you should be buying there, because you want to be buying at the bottom of the cycle. From an investment perspective, at least, you don't want to be buying in a location that goes up by 20% and then has a correction by 10%. And I'm not saying that's going to happen in Perth, but it's a higher entry point risk at the moment than it was last year or previous years gone. Now, I'm not saying none of my clients are buying there. For specific strategies, value add, granny flat, at the higher price ranges, they're still buying there, but it depends on their own personal financial circumstances and risk appetite as well. Everyone is different. There's no cookie cutter approach. Brisbane, under this base case scenario, is going to go up a lot as well, 9% to 14%. Darwin, 5% to 8%. I think this is the one I'm least confident about. I think if there's enough sentiment wave of investors going into Darwin, we might actually get more than that. Or if people actually clue on to the lack of fundamentals in Darwin and the sentiment based on buyer's agent content doesn't really get traction, then we might not even get this 5% to 8%. This is entirely dependent on investment sentiment, because local owner-occupier buying activity is very shallow. And that's the market that you have to be very careful of entering with those kind of illiquid dynamics. Melbourne, negative 5% to negative 1%. I do think Sydney and Melbourne will fall in 2025. Now, that's not to say there aren't locations within those areas that'll go up by 5%, 10%, maybe in 15%. I know in Melbourne, the locations that my clients have already been buying for almost a year have already risen 10%. So there's always markets within markets. I'm not talking about Melton, by the way. And also in Sydney, it's really more the inner West, that is dropping already by 10%. Now you might be watching this thinking, hey, my place hasn't gone down 10%. I live, in a good location in Sydney. There's pockets that are dropping very swiftly and pockets that are maintaining their own, and pockets where Chinese money is still coming in and auctions are going well above their reserve. So Sydney's a bit of a wide variety of outcomes at the moment, but on the whole, the median headlines will tell you that it's dropping, and it will continue to drop in my estimation. Adelaide continues to be, like that horse that just won't give up. It's already run its race, but it's continuing to go because there's just a lack of houses. There is a huge housing development on the north side of Adelaide that once it gets up, I think for many years, Adelaide will become pretty stable. But right now, with affordability the way it is, there's a lot of investor sentiment still strong there, and the same can be said for owner-occupiers. Hobart, -3 to +2%. It's just finally starting to recover from the doldrums in 2022, 2023. Finally, it's starting to take a breath after that correction phase. I think the sideways activity could continue for a couple or more years, just while it consolidates after having been the best performing city in Australia for house price growth in the last 20 years. And Canberra, very unaffordable. We're seeing an election coming, which generally means that hiring activity from the federal government is soft. That means that this level of confidence in the ACT is low in 2025 with the federal election coming. There's not a lot of expansionary projects, and vacancy is the highest in Canberra versus any other place in Australia. I expect that to be the softest market now, in the next year, and potentially the following year as well. Unless you see Labor win again in 2025, the federal election, and go on a massive spending spree, which I don't think is going to happen in terms of hiring employees and beefing up the government, which we don't really want. So overall, you're going to look at the market and see news media outlets saying property market flat, property market down, +1 to +4%. Keep in mind, if Sydney tanks by 10%, which it very could do, Sydney is the most cyclical market in Australia. I've proven this in different videos with charts. I know this is not popular. People in Sydney always get triggered when I say that. It's actually more cyclical than even Perth. It's actually more cyclical than most regional locations. It goes up and down a lot. I won't try to prove that in this video because I've done that previously, but if it does take a big hit and affordability doesn't improve as interest rate drops, then it could drop by 10% or more, in which case the overall weighted average for Australian house prices would go down, and people would see that as a massive correction to Australia. But you can see markets within markets. There will be locations within Sydney that continue to do well. There will be Brisbane, there will be Perth, there will be Adelaide, and so many regional locations that I'm going to get to that will continue to do well. So moral of the story so far, don't listen to mainstream media when making investment decisions. Scenario 2, no rate cut. So you see that Perth's growth is tempered to 7 to 11%. Brisbane's growth is tempered to 5 to 9%. Darwin, pretty much the same as before, so it's affordable market. It's not really reliant on interest rates to get that little bit of a boost in house prices. Melbourne will fall even more with no rate cuts, -7 to -3%. Adelaide's growth will be tempered because now it is starting to become quite unaffordable for locals, not necessarily interstate investors, but for locals. 4 to 8% growth, which is still very healthy given the long-term average for Adelaide is about 5 to 6%. Hobart, -5 to -1%, and Canberra, -8 to -3%. I mean, that would be huge if Sydney falls 10-ish%, Canberra falls 10-ish%. Definitely the media will have a field day, and overall house prices would go backwards. I actually think, in my personal view, I think this could well be the outcome that we achieve. No rate cut. Who knows what will happen? It's entirely up to Trump's policies. If in fact they are inflationary, then we may go 2025 with no rate cut. I know most of you will hope and pray for a rate cut, but I think we need to be realistic while hopeful. I know all other property spruikers and YouTubers and podcast hosts, they're going to say rate cut on the horizon. That could be true, but I just want to be realistic on this channel. I've made that kind of mistake before. Let's assume no rate cut and buy properties accordingly that will grow regardless. And if we do get a rate cut, great, we get an extra bonus. Now, the most optimistic scenario, scenario 3, where we get a really early rate cut in March, that basically puts a jet engine, the burners on fire under Perth, another 20% growth. I think that could be 20 to 30% realistically. Brisbane, 11 to 16%. Guys, get into Brisbane. My clients are buying select locations in Brisbane. This decade for Brisbane is like the 2010 to 2020 decade for Sydney. It's all roses. I've always said if you want to get a slice of pie in Brisbane, then go for it, because in 5 years time, in 6 years time, in 10 years time, ain't no way prices are going to be at these levels again. There's no massive correction happening to Brisbane. There's just too much going for it, which can't really be said for a place like Melbourne. I mean, since 2020, house prices in Australia have gone up about 33%. Capital cities, that is. Regionals have gone up even more. Melbourne has only gone up 6%. That's nominally. On the real basis, post-inflation, it's actually gone backwards. So it's the biggest population center, biggest populated city in Australia, but it's gone backwards. It just goes to show that all these vanity metrics of world city, you know, world acclaimed lifestyle city, always wins on these lifestyle rankings, biggest population, these things have no bearing on house prices if other supply demand dynamics are not pointing in the right direction. You need to learn this science. You can't just read a media article or talk to your mates or go by your feeling of, yeah, I feel safe to buy in Melbourne because it's such a big city, so many immigrants coming in. That's not quite how it works, guys. Darwin goes up by double digits if we get an early rate cut. Melbourne goes up despite everything that I've said, although I don't actually think that wouldn't happen. I think Melbourne will not grow by 6% even if we get an early rate cut. Sydney goes up by 3 to 7%. Long-term average, not great, not bad. Adelaide goes up 10 to 14%. So somehow or other, despite 3 or 4 years of huge growth, it continues to go to the moon. And Hobart and Canberra go up by 1-ish to 5-ish%, underperforming their long-term average. And overall, the housing market goes up 6 to 10%. It's a really bad outcome for the economy, for young people, for housing costs, because it just means another year of outperforming house price growth versus long-term averages, which is about 6 to 7%. It's not good for the economy. I genuinely don't want house prices to go up 6 to 10% on average across the board in Australia in 2025. I personally, for the betterment of the country, would prefer scenario 1 or scenario 2, because investors, we can still make bucks. We can still go to the bank and make 20-30% growth this year, but overall the market is consolidating. Overall the market is going sideways, which I think is needed after the COVID boom. And scenario 4, which is the most pessimistic view, which I don't think is going to happen because immigration cannot be stopped overnight, at least not the way that our government sees it, is not going to go down to 400k. But if it does, then overall house prices do go backwards. But once again, markets within markets, there's 15,000 suburbs. There's going to be locations that go up in Perth, more than 10%, in Brisbane, 4 to 8%, if not more, some less, some more. Melbourne will take a massive hit and Sydney will take a massive hit. I definitely don't recommend following the herd and buying in Melbourne or Sydney blindfolded right now. I think you have to be very prescriptive. Gone are those days where you can throw a dart in the middle of COVID boom and make a lot of money. Those days, thank God, are well and truly over. You actually need to use science, and Hobart and Canberra will go back as well. I will get to regional locations, but what I want to share real quick is from the NAB Megatrends report, dollar value difference between median house and unit values. This is how much is the difference between a house detached versus attached unit value. And you can see, let's say here in red, it's about $612,000, which is the difference between the average house and unit. Over the last 10 years, it's been increasing. Of course, it's had a bit of a dip and then it went big up around 2020, 2021, came down a little bit in 2022 as Sydney house prices came down, and then it's continued to go up. But what the moral of the story is, you can look at these charts yourself, is for basically every capital city, the difference between houses and units overall structurally is increasing. So even though I do expect unit prices to rise, and you might be thinking they're affordable, I want to buy a unit instead of a house. I live in Melbourne and Sydney, why not just buy a unit? I can see it. It's much safer me, quote unquote. I feel more comfortable buying something that's nearby. Guys, this structural trend has actually been going on since 1970, not just the last 10 years. House prices are continuing to outperform units. Yes, there are cyclical catch-ups, but structurally, you don't want to be owning a unit from an investment perspective. Or, of course, there's always exceptions to the rule, but that's the rule. And to back up what SQM are predicting in terms of capital city performance, here's a really interesting chart from Domain which shows what happens to house prices when population increases by 1%, okay, by 1%. And you can see in Australia, every 1% increase in population grows house prices by 8.18%, which is beyond the long-term average. But this is predominantly contributed by Perth, 4.8%, and WA more generally, 4.8%, followed by Sydney, 4.23%, and more broadly, New South Wales, 4.23%. So the locations that are best impacted by population growth aren't Melbourne. Okay, Melbourne's down at 2.81%, and that's because a lot of their immigration comes from students, not skilled temporary residents or permanent residents. So a lot of you might be thinking immigration's only good for the big cities, especially Sydney, Melbourne, right? I mean, this basically disproves that. Queensland is ahead of Victoria and Melbourne when it comes to the effect of immigration. And Perth, I mean, no one likes to hear this, especially if you're a Sydney-sider, because I think it undermines your city. It doesn't undermine your city, but here's the stats. Perth benefits and has benefited from immigration more than Sydney over the long term. The data proves it. And this population growth isn't slowing. Okay, CBRE, SQM, and Qualitas have done this forecast 2023 to 2033. Okay, 10-year forecast. I know we're already 1 or 2 years into it. But what it's showing is that Canada is expected to have the biggest population rise out of any other country in the world, followed by Australia at 15%. Now remember, I just showed you based on stats that every 1% grows house prices by 8%. Now if this is growing by 15%, 15 times 8, that's more than a doubling of house prices. Now, you might throw the old spanner in the works and say no one will be able to afford them. Wages aren't growing. I've shared stats before and charts on how wage growth and house price growth is completely decoupled, that affordability isn't dependent on the average person, but rather skewed towards the wealthy. All things that aren't good, but are facts. So if you look at a chart like this, I'm not trying to create FOMO, but I think I am accidentally creating FOMO. You want to be buying real estate right now, not in 2033 if you can help it. Especially since the residential building approvals continue to go down. I mean, structurally, both in terms of approved, the black line, and the completions, both of them are coming down. There's few green shoots in the last few months, but definitely below the target of 240,000 per year that the government has. We're almost 100,000 dwellings under that target on a yearly basis. So population goes up, not enough supply. I mean, it's the age-old story. I think everyone's sick of hearing it, but it's the truth. And I know a lot of you follow a lot of other YouTube content, maybe from America, other places, and a lot of that content really works well because they're always predicting a crash and negative stories sell. Martin North, for example. But I mean, there's so many multifaceted ways to get at this to show that house prices are continuing to climb structurally over the medium to long term. Offset balances, okay? Right now, through this tough period of cost of living, crisis, you could say, offset balances continue to go up. In September 24, they're at 63 billion. So people have all this money. I know a lot of people are struggling, but it's not those that dictate house prices. When there is so much money in Australians' offset accounts, what do you think they're going to do with it? Are they going to pay off their loans? Of course, yeah, a lot of them want to do that. But more and more so now, people are cluing on to the fact that they can multiply their wealth, not by paying off their mortgage, but taking that offset and buying more real estate, because it's only going to go up according to population forecasts and current supply pipelines. And the second last chart I want to share is, a lot of you might be saying to yourself, you know, right now people are struggling, house prices are so high, but loans have increased and therefore there's so much indebtedness and people are in negative equity. Well, get this, higher house prices have actually improved the average LVR or leverage ratio. So what is the percentage of people with negative equity? Late last year in 24, it was 0.08%. Now that's the lowest it's been ever, like ever. And that's because, yes, people have loans. Okay, yep, they have plenty of money in their offset accounts as well, and that's growing. But house prices have grown as well. We're seeing no one basically below water. Everyone is able to breathe in their repayments, in their household balance sheets, and therefore no one's having to force sell their property, especially with interest rate cuts on the horizon potentially. This situation is only going to get better. And there's lots of regional towns where this effect is especially pronounced. Places like Albury, like Bundaberg, like Fraser Coast, Mackay, Cairns, Toowoomba, Sunshine Coast, Gold Coast, which I still remain in saying it will be the best performing housing market over the next 15 to 20 years because of no land available and huge population growth forecasts. If you want a deep dive on regional Australia, leave a comment regional below. We've run out of time in this episode to go through a lot of charts on regional, but that's really where a lot of opportunities still exist. Large regional centers that are as diversified as secondary capital cities. Great opportunity for Australians who invest now. They won't be regretting it in 10, 20 years' time as Australia's population goes up 15% in the next 10-ish years. Guys, that was a long episode. Hopefully it brought you a ton of value. Hit the subscribe button if you did get value. Okay, now that you've made up your mind, give it a like and please share it. I know a lot of people will disagree with what I've said, your friends, colleagues, partners, etc. Give it to them, allow them to be educated. Hopefully none of what I've said is opinion. I've given you 7 charts. There's more than 3,000 charts that I've shared on these types of videos before, and I'll continue to do them. Comment regional if you want a regional deep dive. A lot of money to be made this year, despite the fact overall house prices may actually fall. Go figure. See you guys.